Welcome, active investors, passive investors, traders. Welcome to Technical Market Insights. This is going to be our first episode, basically pure educational. All right, we're not doing any stock market updates, stock market analysis. We are getting into the educational, how to read a stock chart. We'll shoot some more videos later on how to scan for specific stocks, how to find strategies that actually work, and strategies that actually work. Now, the stock market is a great place to build generational wealth, but you should educate yourself in all aspects. One of them, you should know how to read a stock chart. The benefits of reading a stock chart are absolutely amazing. So if you don't know how to read a stock chart, even if you do, tune in, because we're going to be going over a lot. We're going to start with the basics of just different types of candlesticks. We're going to start adding indicators, and we're just going to start digging into it. So let's go. So right here is your basic candlestick stock chart, right? Each one of these, we're on a daily chart, so each one of these is a day. Green means it closed green. Red means it closed red. And these are the candlesticks I prefer to use. Now, a lot of people, first let's look at the different type of charts you can pull up as far as candlesticks. So we're going to go to, right, we're on candlestick. You can do it just a line. What does a line tell you? Really absolutely nothing. So it shows you the price movement. The green means it's going up. Red means it's going down. I know a lot of people post charts like this and look at charts like this, and I have no reason why. I don't know why anybody would look at a chart like this. To me, it doesn't tell me anything besides the market goes up and down. Everybody should know that. All right, so let's look into another one. Now, we could go through each of these, and this video could be so in-depth, but I don't want to bore you and give you a bunch of crap that, almost like they do in school, right? They fill you up with stuff you ain't going to use, stuff you don't need to know. I want to get to the meat. Going through a little bit of milk first. So this right here stands for open, high, low, close bar. Meaning this bar is going to show you the open, the high, the low, and the close. So this bar actually does tell you a little bit. So you could use this if you wanted to. It's not my preferred bar by any means. But like if you look at this, let's see. Over here it tells us the open was 187.30. That's fine. I believe that was that line right there in that bar. Should be 187.30. The low was 186.86, which is right there. And the high and the close. The high was 182.87. The close was 192.77. So that it's really that bar that goes over a little bit to the right is your high, and that's your close, and so forth. So this is your open, your low, your high, your close, or your, I'm sorry. So that was the close on the right. That's your low, is the bottom of the candlestick. Your high is the top of the candlestick. And your open, I believe, is to the left. Yeah. I don't use these, but you can. Okay, so that actually tells you something. Not my favorite, so I'm not going to go in depth into it. All right. But you want candlesticks that actually tell you some price movement of the day. Now, these are not hard to read, but they're not as easy to just look at and read like you can with a candlestick, and we'll get to that in a second. So this bar is a high, low, close. That's all it shows you, the high, the low, and the close. So if we go to that, so your low is obviously the low of the bar, your high is the high of the bar, then you got your close. And then if it's red, close lower than the day before. If it's green, it close higher than the previous day. So that, I would probably use that bar before I did the other one. Just because the less complex, which ain't even really complex, I don't like using that term, but the quicker you can just look at it and understand what you're looking at, instead of one coming off on this side, one coming off on this side, you got to figure out which one is the open and the close. I would much rather just one line coming off showing me the close. And if I want to know the open and the close, then I'm going to use the candlestick, and I'll show you why. So this is the candlestick which we were at. I'm just going to go down in order. So you see how this is filled green? So that means it closed lower than it opened. So now it closed higher than the day before, but it opened at the top of the candlestick, closed at the bottom of the candlestick, and then the wicks are your high and your low. Okay, so you can look at this and just tell by the color, by it being filled in, what happened, right? It closed, that I know closed lower than the open, without looking at two sides coming off, trying to figure out which is which. Now the clear green, it opened here, it closed here, it's high, it's low, opened here, closed here, high, the low is the open, and dip into the red, you got the same thing. So you got the open 192.80, which was here at the top of the bar, and it closed at 189.90, and you got your high and your low. Okay, so now this one is empty, right? So what does that mean? The open should be down here, 173.61, and it closed. So I know it closed higher than the open because it's blank, right? It's clear. So these candlesticks are much easier to read than some of this other stuff to tell you kind of what's going on with the day. So this is a straight bar graph. Why anybody would look at that, I don't know. Seen people do it. This tells you absolutely nothing. It just kind of goes up to the price range and tells you if it closed green or red. We'll dig into the area. This just shows you the area. Once again, tells me really nothing about the price action for the day. Now you can always play around with this stuff, but as far as I'm concerned, I don't need to. Now this is a very interesting candlestick. This is a Japanese candlestick. It's called the, man, I'm not going to pronounce it correctly. Heikin Ashi candlestick. Don't know, don't speak Japanese, speak American. I know I messed that pronunciation up, but so this is based off moving average. Now all your technical indicators are going to be based off moving average, 90% of them, if not all of them. So when this turns green, they're trying to say the moving average means buy. As you can see, it's not 100% accurate. This is a change of, basically meaning it could change directions, but this is a candlestick that is involved on moving averages. So it's definitely interesting. I don't prefer it. Don't really like it. It's not as accurate as it could be. And honestly, if you put the 3 and the 5 day moving average on here, it would probably tell you more than this would. So like if you put the 3 and the 5 day moving average up there, if the 3 crossed over to 5 is a buy, if the 5 crossed over to 3, it'd probably give you a better accurate direction of the market than this would, even though they're probably based close to the same moving averages. So now I'm going to go back to what I prefer, what my opinion is you should learn how to read, and I'm not going to dig into the rest of them, which I mean dig deep into them. Like I said, I want to keep the video short, and I want to only give you the information that I feel like you should know how to read. I don't want to overload you with a bunch of crap and you come out of this video not knowing what the heck's going on, right? This ain't elementary school or high school. All right, so we got our basic candlesticks. I know right here, man, it opened here, closed here, and that was the high. And that's a pretty bullish bar. Now we could get into all these different bear flag, bull flag, all these different type of chart patterns, but we would have to find them specifically, look for them. The main thing you need to look for is higher lows and higher highs, right? That's going to indicate a bullish pattern. You see here, it pulled back. That was the low there. High didn't really get higher. That almost maxed out. Low got a little lower, but look how toppy that top is, right? It hit resistance there, hit resistance here, hit resistance, and it had a bigger pullback. So you want to see everything going up higher. So let's look at, I got all the symbols over here in the ICAP 1000 going from A to Z. Notice that's the only specific order, and I'm not going to really dig into percentage gains or anything like that on that over there, or even here. But we're just going to look at these basic candlesticks real quick, and I just want you to kind of get a feel. So go through, whether it's your brokerage, whether you use TradingView, learn how to read a basic candlestick, all right? And patterns, the only thing you need to know is you need to look for resistance, and you need to look for, are the lows getting higher and the highs getting higher, or are the highs getting lower? For instance, look, this is the overall market right now. This is a semiconductor ETF, but this is what all the ETFs are looking like as far as Dow Jones, SPY. See how the highs are getting lower? The lows are getting lower. It's going to a downtrend. Not a huge one, but it's going to downtrend. It's going to pull back some more. I mean, this was Friday, and you can look at our past videos. I mean, we called this based on some other indicators that we're going to start putting up here. But you should be able to look at these candlesticks and know what happened. So this one opened, I mean, it opened all the way up at 156.46 and closed down. I mean, that's a huge red bar. So it opened up there and then dropped, traded all the way down to there. So to me, that's not, those big red candlesticks are not bullish by any means, but they happen even when they're going up. So what does that tell you? Can you look at just candlesticks and tell how the market's going? Not really, right? You need to add some more indicators, but keep it simple at the same time, because you don't want things to be overly complex. So to keep things simple, let's look over here at the possible indicators. Now there are so many different indicators. There's all this oscillators. I mean, it's crazy. So this right here, some of these say, oh, if it goes this, you know, if it crosses down, you sell. If it crosses up, I can tell you, I've been through all of these, and they're all based on moving averages. So I like to find the most simple one I can find to give me a strategic and tactical buying opportunity. Okay, and we'll go over that here in a minute. But one thing also is everything's based on moving averages. One of the most major moving averages is the 200-day moving average, and that's one of my rules and my trading strategy, which we'll go over trading strategies later. So we're going to look at moving averages, and let's add that to our chart. So I don't know, and there's different types of moving averages. We're going to go with simple. We like to keep things simple. Okay, that's putting on top of that, that's that. So it automatically put to 50. I usually keep the 50-day moving average on my chart, but the main one I want to look at is the 200-day moving average, and we're going to make it green. So I'm using TC2000. Some of you guys might be on your brokerage. Some people might be on sites like TradingView. I don't know what you use, but all the indicators and moving averages I put up here, you should be able to find whatever you're using. If not, you need a new platform. So this is the 200-day moving average in SMH. Now, just to kind of give you an example, this crossed under along with the rest of the market in 2022. It dropped as low as, I can get that right, almost 40%, 37%, 37.8%. And by the time it crossed back over and started holding, it was still down 20% from when it crossed under. The 200-day moving average, which you can see in my book and in multiple examples I give in other videos, it's under the 200-day moving average. I do not touch it. All right, so if you're writing down, taking any notes, under the 200-day moving average, no go. That means it's trending lower than the previous 200 days. I'm out. So this is the moving average of the previous 200 bars. So if it's on the monthly, it's the 200 months. If it's on weekly, it's 200 weeks, and the daily is 200 days. So if it can't hold above its 200-day moving average, I don't want to hold it in my portfolio. And we'll get to more later on that in our trading strategy edition, and there's plenty of other examples in some other videos. So one thing you should always have on your chart is the 200-day moving average, because you want to know, A, is it trending up? Is it about to break below it? If I'm holding something that I want to make money on, I want it to be trending up and holding over its 200-day moving average, period. If it can't do that, why do I want to hold it? So those are two things your chart should look like right now, as a regular candlestick and the 200-day moving average. All right. Now, what else can we add to keep it simple? Excuse me, because I have a drink. So I'm trying not to bore you guys with this, because to me it's pretty basic and boring, but I've been doing it for 23 years. And I want to keep it simple and not jump all over like my mind's doing right now when I jump. So the next thing we're going to add is called Bollinger Bands. Now this was, and we're going to edit it. This was created by John Bollinger, and it's a set of bands based on a specific moving average. Right now it's based on the 20-day. Now on TC2000, I can make this whatever I want. So I want it shaded because I want to be able to look at it and see the channel. So this is a channel. I want to show the middle. I know it's got a plot center line. So that is your 20-day moving average. Now if let's say I trade that to 50, it's going to open it up more, and that will be the 50-day moving average. I don't want that. I want the standard 20. Right, you can play around with all these, change the moving averages. I don't want to do that. So there are people that will, a long time ago, I met a trader, been doing it since I was born, 1982. And man, it was different back then, but this is all they would use. Right, he said he loved the Bollinger Bands, and that's what he still does today. He basically trades based on the bottom Bollinger Band. As you can see, it's definitely a possibility. You can buy at the bottom Bollinger Band, sell at the top, buy at the bottom, sell at the top. But you want to make sure it's trending upwards. If it's trending downwards, you're still possibly get slaughtered, because things can break straight down. As you can see, it hit the bottom, but it kept going. Now, one thing, when you see a gap down, I don't buy gap downs, because usually you can get burned trying to hope it's going to bounce. A lot of times it carries momentum all the way down, especially when it crosses under the 200-day moving average. So that crossed under the 200-day moving average, and it's still, even though it's a great company, I don't want it in my portfolio. I want only winners in my portfolio. All right. Now here, this probably pays 5% dividends. It's a healthcare stock that probably pays close to 5%. Dividends. Last I checked, it was probably 4 something. But over the last year and a half, it's done nothing for your money. Right? It's besides pay you dividends. And if that's what you're investing in, that's fine. But you can find stocks that will pay just as well dividends, if not a little less or a little more, but be on a bullish trend. All right, you're going to make more money on the growth of the stock, or even trading that stock, than you're going to from the dividends. But here, if you're passive and you just want to invest for the dividends, you want to invest for 10 years down the road, it's not a bad company to hold. But if you're active, you're going to be able to make more money just by being able to read a chart, So let's get deeper into that. Let's look at a few others. Airbnb. That crossed under the 200-day moving average down here. And dropped pretty good. 50% in 8 months. Man, that hurts. And as you can see, when it's above the moving average, now here, it hit the bottom Bollinger Band, kept going down. But it swing up, you still would have been about normal. So we got the 200-day moving average. We got the Bollinger Bands. And the Bollinger Bands really just, when you look at a chart, you need to be able to look at it and you need to know what's going on, but you want your brain to communicate it to you quickly. All right, you want to, and that's all that channel does. It's help your brain communicate quickly where it's at. If you pull this up and it's up here, I mean, it did break out a little bit, but you want it at the bottom of the Bollinger Bands. Even the other indicators I'm going to add, even with those, I like to stick to the bottom of the Bollinger Bands. Now there's a ton of other channels. There's let's see here, Catlett channels. Let's put that up there. So I'm going to take that out a little bit. Instead of deleting it, because I'm going to put it back up there. This is the 10-day. I think this is based on the 10-day moving average. So you could use this. What does this tell you really? I mean, are you going to buy only when it's at the bottom, sell at the top, right? Hey, if you like buying low and selling high, you need some channels and some indicators to tell you what that even means. And you need a moving average and some strategy, something to kind of tell you what your plan needs to be. Okay, because no matter what you enter, you need to have a plan for your entry and your exit. Okay. Now here, there's some people that buy when this goes. Oh, there's a million different strategies out there, but the main thing is knowing how to manage your position. Okay. So you need to know how to make you could buy when it crosses over the bottom, right? I know some people do that. If it goes out of the bottom, if you put a alert up or a scan, which on TC2000 you could. But when this crosses out over the bottom, you buy, and you hold till it crosses over the top. That actually might not be a bad strategy, right? There's a million different ways in the market. You could actually devise a strategy to make profits, but at the same time, you're not going to be right 100% of the time. There's no technical indicator that's going to tell you it's about to reverse and keep going up. Right? The main thing is managing your position. Because right here, look, it bounced up and then head fake. So now I've went through every single technical indicator over the last 23 years on every single stock chart from A to Z, pounding my head against a wall. Live tested, been trading for over 23 years. Well, 23 years this November. And what I'm going to put on here and show you guys is what I use. And it's my personal opinion on what you should have on your chart and know how to read. All right. And we'll go by, you can put it's your chart. I don't care. You can put whatever you want on it. Not going to affect me at all. But I'm just telling you from what I've done, my experience, it's what works best. Keep the Bollinger Band on there. It's going to help you just look at the chart, kind of know a little more what's going on. Okay. Like look, even Apple, it broke down through the bottom and has been running. Apple, honestly, I was looking at that day chart earlier. I couldn't tell if it was holding the 200-day moving average. But it's been holding above it. And really, there's one other moving average I'm going to add and keep up there. We're going to add some others, some of the popular ones, and go over it. Let's see here. Whoa. Oh, there we go. All right, so this is stochastics. Might not have said that right either, but whatever. I'm gonna pull that out. And this is all based on moving averages. And you can go in here and you can make them slower, you can make them faster. But I want one line green. Once again, that triggers your mind buy, red triggers your mind sell. I'm gonna make this red because there are people that trade based on this crossover. If the green crosses over the red, they buy. If the red crosses under the green crosses under the red, they sell, and so forth. So you could literally make that your trading strategy. If it crosses over, which it did right here, but guess what? It didn't keep going. Every trading strategy you come up with based on all these technical indicators, they're never going to be right 100% of the time. Never. And my strategy ain't right 100% of the time. A lot of my strategy has to do with managing your position. And we'll get more into that. Right? It's looking for bullish charts on a pullback and then managing your position. So on the stochastics, anything over this green line, which is 80, is overbought. Anything under the red line is oversold. When would you want to buy something? When it's overbought or oversold? I like buying low, selling high. Everybody wants to buy low until it's time to buy low, right? Then you're scared, then your emotions kick in. But there's a way to handle that. So ACN, this isn't anything I want to be in. Right, there's very few bullish charts out there right now. I know one of them because it's in my portfolio. I mean, I could probably think of a lot more, and I could pull scans up and we can scan, but we'll leave the scanning till we get to the scanning educational clip. You can watch my weekly commentaries and analysis we scan every day through the week. Right now, we're not getting into scanning. But bullish charts, I mean, I might for just showing you guys. So this came up on my bullish chart list. It was actually kind of November, December. I think it was actually right around here in December. Pulled back, I was watching it, did some research. So anything that comes up, whether I'm trading or investing, right? I keep two accounts, one long-term investment account, one trading account. No matter what, I want to make sure it's not trash, right? I don't do penny stocks. I don't buy and sell options. Don't get me wrong, you can make good money, but it's very risky, and you can also blow your whole portfolio, blow your whole account. I work too hard for my money to do that, so I don't want to do that. So, as you can see, this has been setting lower lows and higher highs, right? That low dropped a little bit. I don't remember what happened there, but I know it loaded up. I think the overall market pulled back. And it's been lower lows, higher highs. Since I bought this and been telling people it's a buy, it's up almost 40%. So I found it on my scan. I read the chart and I looked at the fundamentals. It was trading at a good PE and it pays a dividend. And the reason I bought it was on Trezo Fuel and Project Peel in the chart. Right, and I put it in my long-term portfolio because the research I'd done, I believe it would be valuable in 10 years as far as Trezo Fuel, Project Peel. So I speculated, but I speculated in a company that's already making good money, already got government projects and contracts. Their chart's bullish, and they pay me a dividend. Those are the things you want to add to your portfolio. Those are the charts you want to read, okay? Now, if this chart was trending down, it'd be the total opposite direction, right? It'd be trending. Why would I want to put my money in something trending down, right? I want a good company with a good PE and a dividend. I want a nice bullish chart, and you will outperform the market, man, over and over and over again. But you got to be able to manage your position. So if something hits oversold, let's look at oil. Let's give you an example. So oil right here. If you're reading the stock chart, it's oversold right down here, right? But it just hit oversold, and it ain't touched the bottom Bollinger Band yet. So I would have wanted to wait. But let's say I did buy here. I would have bought with 20% of my portfolio. If I'm trying to trade say I got a trading account, I'm trying to focus on one trade at a time, and scanning. This is probably the most bullish sector out there, right? Look at all the other sectors, which we can go through, and you know what, we will. It's a good learning lesson. So if you bought here and you only enter with 20% of what you plan on trading, it don't have to be your entire portfolio, but let's say you plan on putting 10 grand in here, you entered with 2, right? Don't ever go all the way in, because you're just killing yourself. You ain't able to manage your position. So like I said, there's no trading strategy that works 100% of the time. But if you add a good tactical strategic entry, you know how to read a chart, make sure it's bullish, and then you manage that position properly, you're going to be doing quite well. So right here we got oversold. Let's say you bought there, because normally I wouldn't buy on a gap down until a couple of days later, because usually, like I said before, gap downs usually carry momentum. Give them a little bit, but it's still a bullish chart. Okay, so if you buy here, well, you only did 20%, you had 4 more times to enter. You would have been down about 5% here. You would have definitely put another 20% of your portfolio in, so you'd be about 40% in there. You would have dropped another 2% there. That's deep and oversold. I would have won another 20%. I've been about 60% of my portfolio or my trading amount in. My average would have probably been right around here. And you'd be up about 5%, and it hasn't even hit the overbought condition yet. So realistically, you'll probably be up about 10% overall. And considering this isn't leverage, which if I trade an ETF, I usually trade leveraged ETFs, that could be 20 to 30% gain within a month, because you know how to read a chart. It's bullish, right? The everyday candlesticks, I look at them, but you got to look at the overall picture, right? You want to have your Bollinger Bands, you want to have your 200-day moving average, you want to look at your lows, your highs, and you want to see if it's oversold. Now that's not too many things to put on a checklist and check off. It really isn't. You have people with all these other indicators and the chart looks a mess. You look at it, you really can't tell what's going on besides the market's going up and down. Get you a basic candlestick chart. Get you some Bollinger Bands, a 200-day moving average, the stochastics, and learn to manage your position. And look at that, I shot a basic chart reading video and a trading strategy that works all in one, because that's really about all you can find that's going to work. There's not, let's go over some other indicators just so you know. One thing a lot of people use is RSI. You'll hear that a lot. This is an indicator. All right, and I'm going to keep them both up. Let's mark them. See, when you look at that versus the red and the green, mentally, it just coincides better. You got red and green up here, red and green here, red and green. You want to be able to look at your stock chart. Colors should line up well. Your mind should be able to process it very simply. Not that you have to make an immediate decision, but all right. Change that to red. All right, green and red. This is probably the only colors you're going to find on my stock chart, really. Besides the back being black, and that works better for the video. Whatever works better for your eyes, really. So, these are almost identical, all right? Besides one thing, the oversold condition. So some people wait for this to get to the 20 mark, like the stochastics, to get oversold. And they don't hit it at the same time, right? There's a little different. If I'm looking for something to tell me if something's overbought and oversold, so look right here. This is, the stochastics are 20, RSI is 35. So you almost got to change your, let's move RSI to 12 and see if that, so that, see how it changed it, but we're still at 20 to 32. So you go around and play with these moving averages, but this is 12% of K3. It's honestly, I've studied it, I've wrote about it, but I don't use it. That's why I don't want to teach you guys stuff you ain't going to use, because it's the K line, which is, I want to say the bottom line. I don't even know. Whatever, doesn't matter. The only thing I know is this works way better than RSI. Now don't get me wrong, if you find this at 20, which is 24 there, and stochastic is 8, it's probably really oversold because this is lower. But if you wait every time for this to get to 20, you're going to miss out on a lot of swings. I've had people even argue with me that something wasn't oversold because the RSI wasn't under 20. And I pulled that chart up and I looked at RSI every time under 20. And I even asked them, when was the last time you would have traded that? Because I've been trading it, making a killing every time it's oversold on the stochastics. And you ain't touched it. So don't limit yourself to something like RSI. So let's see, there are, and you can make custom channels. You can do all types of crap on here. Let's look at a couple other VWrap. Some people use, okay, so some people use VWrap and you can change this. Some people buy when it crosses over this, sell when it crosses under, and you can even change your moving VWrap, let's say to, first I'm going to change the color to red because I don't have red on there. Let's change it to 20. Puts it right at the 20-day moving average. So that is basically almost aligns as a moving average. So honestly, if I used a VWrap, I would use something more short term, like a 5-day. All right, but look at it, you're all over the place, right? Maybe if it's oversold and bounces over the 5-day, that can trigger a buying opportunity. But there are plenty of different situations. So yeah, if you would have waited till it was oversold, which I can tell you I've tried this, because then if you sell when it goes under it, you would have sold right there, unless you just manage it. You can play around on TC2000 and other platforms like TradingView, your brokerage account. I know E-Trade does have a really nice chart set up. I don't use it. I've always used TC2000. So you can put all these different technical indicators on them and try to trade, but they're never going to be 100%. Never. How do I know? Because I've done it. So the best thing you need to know, how to tell if it's bullish, if it's trending up, have a 200-day moving average, have a Bollinger Band, and have something that's going to tell you if it's oversold or overbought. Let's look at a couple of, I mean, man, look at that. Bristol Myers. What a great company, right? I mean, maybe you don't think so, I don't know, but they're a huge pharmaceutical company. Let's say you had this in your portfolio and you scratched it the first time it dropped under the 200-day moving average. You sold it right there. Which last time it bounced up, let's say you bought it, you were holding it, you were up 15%. I mean, you'd still been up 3%. That's one reason I don't hold a lot of stuff long term. I got to have a good company with some type of R&D into something that's kind of speculative for the future. Really, the majority of my long-term accounts are my custodial accounts. Got 3 custodial accounts, and then another account. And a lot of it is for income. But if you're investing for income and you're holding companies like this, if I'm buying an asset just for income, why not hold DIV? It's doing as crappy as that, but it's going to pay you more and pay you monthly. But you can hold, this is a mutual fund that I have in some of my kids in a long term. Mutual funds, just the way they trade, they always show up like that. Sometimes you got to adjust it to the 2-day just to get a candlestick pattern. But it's almost under the 200-day on the daily. Did cross under. But this is something, if you plan on holding for 10 years, whatever. But the majority is WXT. thing is, my kids' custodial accounts, by the time they get access when they're 21, and they hold till they're 30, it ain't gonna matter. But if you're trying to make an advantage and outbeat the market year over year over year, you do have advantages. Okay, you can dollar cost average into the market all day long, and you can dump a ton of money. Look at the monthly. All right, this is your monthly chart. All those people that were dollar cost averaging here, yeah, 10 years from now, ain't gonna make a difference probably. But if you see that and you're like, well, I might as well pile up cash, and you see what's coming down the line, and you see the monthly's probably gonna pull back, and so is the weekly, which we've been talking about in our weekly commentary and analysis. Why keep dollar cost averaging, right? Why not find something bullish to put your money in? Why not change things up a bit to beat the market? And you can actually go in, I don't know why it's been doing that on SMH. For example, my conditions, this is all your bullish charts. So there are 77 bullish companies out there in the high cap 1000. So right now, out of 1,000 high cap companies, only 77 are bullish. Now I have a feeling over the next year, you only have the bullish charts in your portfolio. You know how to read a stock chart, you know how to make a scan to find you these companies. I mean, look at that chart, it looks beautiful. If over the next year you just put the bullish companies in your portfolio, you're going to outbeat the market every time. If something doesn't turn bullish, get rid of it. If it drops under the 200-day, get rid of it. So these aren't, the only thing I don't have in this scan is being over the 200-day moving average. It's based on really the last month of closes. That's about 8 months. Probably because we're still on the weekly. It makes more sense. Let's go back and look and see. Yeah, even our weekly charts look great. Well, this is your daily, and it broke out right here. So you got to be able to just filter through them, right? You can't even depend on your scans, because the scans I got set up are based on this high is higher than this high, and this high is higher than this high. I'll show you. This is just one of my bullish scans. So if I go to edit, so this is what one of my bullish scans is based on. The close is higher than the 25-day close, and the 25-day close is higher than the 60-day close, and the 60-day close is higher than the 115 close. But you still got to be able to pull up the chart and see if it looks right for you. Even though those closes are higher, now I could add in there over the 200-day moving average. But usually it is over the 200-day moving average if it meets those criteria, which this one is, but still doesn't look that good as far as I'm concerned. But if you go through these and find the ones that do look good, I mean, that looks really good. Then check your PE, then check your dividend. I like owning stuff that pays me a dividend. Why not? You're investing in a company that pays its employees, why shouldn't it pay its investors? So we could go through all of these, and that's what I'll do. I'll go through these, find out where I want to put my money for the long term, and that's how I build my long-term portfolio. If I'm trading account, I look at the stochastics, and I find out which ones are oversold. Right now, we've really got none that's oversold, and all the bullish high cap out there. But this one right here, I mean, when it gets oversold, it'll probably be close to the bottom Bollinger Band, and it'll probably give you a good swing trade. So when you look at my charts, and that's really what this video is about, is when I do my analysis. Right, I'm not digging into every technical indicator. I really wanted to cover what you're going to see on my scans, what you're going to see on my charts, And honestly, to me, it's a very boring video, so it was probably kind of crappy. Sorry for bad content, but hopefully you learned something. But guys, I'm telling you, you could go through every stock chart, you can go through every technical indicator. You're never going to find a strategy that works 100% of the time, or something to tell you if the market's going to go up tomorrow or down. Okay, you just have to find a strategic buying opportunity and entry, have a plan for an exit, have a plan to manage your position, and if you're not in junk, you should be doing good. Right? If you're in a company that's actually, I mean, this is Berkshire Hathaway, right? This was oversold. This is an example. I mean, it doesn't work all the time. This might take months, right, worth of managing to kind of get under wrap. But here, you look right here, you would have had a good swing trade. Didn't touch the bottom Bollinger Band, but oversold 5% in 27 days. And really, there's multiple examples of Berkshire Hathaway. You know, that's Warren Buffett's company. But this will probably test the 200-day moving average the way it's looking. Now here, if you would have bought over here when it was oversold, at the bottom Bollinger Band, 20% of your portfolio. If you're doing single stocks, don't ever really go over 20%. Gives you 4 more entries to lower your position. And really, I mean, it got as low as 5%. You really might have only bought one more time. But the problem, not really the problem, but you're going to have to be more patient on this one if you enter this. So if you bought here, I would have maybe added another 20% here. So that might have got your average, you might be down 2.5%. And if you didn't like it, you might have been able to go in a little more and manage that position to lock in profits. What you don't want to do is get in a habit of locking in losses. Eventually you start compounding losses and you lose more than you win. So that is what we're trying to avoid, right? You don't want to compound losses. A lot of people get in like, oh, I'm not up, I'm on just a 1 or 2% loss, I'm on just cut it and move on to the next one, and they keep doing that over and over and over. Next thing you know, their portfolio is just constantly going down. But a company like this, let's say I went in 5 times, I'm still not up to lock in profits. That's why I enter companies I don't mind holding for a while. So even if it takes 2-3 months, I'm gonna hold. Now here, if I'm averaging my position, it goes under the 200-day moving average, then yeah, I'm gonna exit. Like back here, look, crossing under the 200-day moving average here, it dropped 13% and traded for a while. It would have took 6 months for you to break even. I'm in my trading account. I don't know if I want to wait that long unless I only got a small portion of my money in it. But even then, that's just one of my rules. It's under the 200-day moving average, I get out. I'll move that money into something better. But right here, you may be down 2.5%. By the time it touches the 200-day moving average, you may be down a total of 5%. You probably go in another 20%, so you'd be 60% of your portfolio in. And waiting for it to hit the overbought condition to lock in profit. I mean, if it breaks, what I pause for is a minute. I don't like trading when they're that close to the 200-day moving average, because if they break, I'm breaking them out. So that'll be the really only time you'll see me lock in any type of losses. This is an example. Raytheon, I've showed you people this if they've been following me. This right here, I got in about ex-dividend. It showed up in my oversold over the 200-day moving average scan. One of these days, basically right before ex-dividend. I don't think I held it that long, so it was probably right around here. I thought it was going to run back up another 10%, plus I was going to collect a dividend, but it didn't. It broke under the 200-day moving average. I locked in maybe a percentage loss. I still collected my dividend, but eventually it bounced back over the 200-day moving average. I had people, oh, you shouldn't have sold. How does it feel now? It was a percentage point difference. And I put that money in BWXT, which you watch some other videos, it's a 50% swing. This went down 25%, that went up 25% since that time. So a $10,000 account, it's a $5,000 swing. So happy with my decision. But this drop as much as 28%, it's still down 23% since it dropped under the 200-day moving average. So if we can't hold the 200-day moving average, get out. Now that's been bouncing off for some time. I took the risk thinking it was going to bounce off a bit again. Didn't do that. But hey, it happens. You're never going to be right 100% of the time. The best thing you can do is know how to read these charts. It's going to give you a benefit and advantage over not knowing how to read them. I mean, because if there was a lot of people that didn't know how to read these charts, holding on to this, and had no clue what I was talking about, and their portfolio is down 28% since then, about 25% since then. Know how to read your charts, set you up a strategy that works, and keep it simple. Guys, that's really the KISS strategy. Keep it simple, stupid. So there's really not much else to go over. Like I said, I'm not going to drown you guys with a bunch of information, digging into every technical indicator. We could have made this a boring 2-hour video. Not doing it. So other than that, if you guys have any questions, any feedback, leave it below. Make sure you subscribe. Hopefully this was informative to you guys. Like I said, it may not have been to some people, but hopefully the people that just don't know how to read a chart, have the line charts, hopefully it helped you out a little bit. Build your chart on whatever platform you're using. And you don't have to use any of this. You can look at the line graph, do whatever you want. Don't bother me a bit. It's your chart, it's your money. Put it to work as you want. But hopefully it's beneficial to you. Look out for some more videos coming. We're going to go over some more scans. I'll do one on TC2000 as a whole. And those will hopefully not be as boring as this one. So hit like, subscribe. See y'all later.